Well, good afternoon, investors, and welcome to our October 3rd, 2023 edition of Bull Sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. We simply do a bunch of investment research and sharing, and we'll talk a little bit more about that stuff. I'm joined here by my dear colleague and raconteur in the realm of investing, Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. Good afternoon, everybody. Glad to be with you. It is a beautiful day up here in Michigan. We're in the 80s in October. I'm writing that date on the calendar because it hardly ever happens, I'll tell you.
Yeah, I think we only have a couple of them left, Ken, so enjoy it while it lasts.
I think we might have one more left from what they're telling us, yes.
Yeah, and I think the blunt end of that club comes back and gets us here in a few days.
Yes.
We could see snow in early October around here, so.
And we have.
We have. All right, I'm really excited about our program here today. We have a very special guest, and basically this is a program that we had presented a few years ago. It was extremely popular, and our special guest here today has a military background, up close and personal experience with the Thrift Savings Plan, and just a whole wealth of knowledge in the investing community. He's a volunteer for our DC Metro regional chapter, and a big, hearty welcome to you, Ty Hughes. Glad you can be with us.
Mark, thank you. I'm glad to be here with you and Ken. I have to say, I've been watching these programs for years, and I've learned a great deal from both of you, so it's an honor for me to be here. Thank you.
Well, we're really glad and thrilled to have you here with us. We are going to be talking about retirement plans in general, but using the TSP for kind of a talking point. I have a lot of optimism that we're seeing progress in just the general, field of retirement, planning and assets. And so maybe I'm a little bit more optimistic than I should be, but I do see great signs of hope, and hopefully things will continue to keep getting better and better when it comes to that realm. So let's go ahead and get underway.
Mark, if nothing else, the paternalism that surrounded so much of retirement savings back in the 70s and 80s, it seems to be a lot of it's been washed out of the system, and that's a real good thing, I think.
Oh yeah, it's been made, as we're going to talk today, it's been made more easier to understand and definitely less expensive, and people are paying very close attention for some of the stuff that we're going to cover. And oh, by the way, that rabbit on the far right, that's not a face palm. He's actually just praying for better results for our best small companies.
Okay, great. We can use it.
All right, we're going to get to the TSP stuff pretty quickly, but here's our Portillo's moment, and this is just the reminder that Portillo's is not a sponsor of this program, but they should be. All right, here's our standard boilerplate disclaimer. No investment recommendation is intended. Everything that we do here is based on our observations and experience of the modern investment club movement. All the stuff we do is for demonstration and illustration. We're talking about some time-honored methods and strategies and techniques that go back now over 8 decades. So you're going to hear opinions from us about those observations and that sharing. Please do your own analysis of any company, or in today's case, a fund, before making an investment decision. So if we own something, we'll try to tell you. Ty is definitely a participant in the TSP. We'll just say that right up front. And we'll get going on this. If you'd like copies of the slides, or if you have follow-up questions for future Bull Session topics or whatever, our 3 email addresses are there. And if you have a specific question about today's TSP content, you can go straight to tyhughes.va as in Virginia @gmail.com. And then just a little added extra disclaimer. Anytime you start talking about this kind of stuff, you have to realize that it is very individual, very personal, specific. And it comes down to your own time horizon, your own investing experience, your own critical mass with respect to how much you have and how much you need to have, and risk tolerance and perceptions. So your own situation could be different. So we will be sharing our personal perspectives. Please take them in that spirit, and we can take it from there. Anything else you'd like to add, Ken?
No, I think you've done a good job, Mark. Let's get started. I know that this one's gonna hit the time mark for us, so let's see if we can squeeze it in.
We're going to try to get this as close to an hour as we can. Here's our weekly check-in on the general stock market as measured by the value line arithmetic average. That last green bar on the right is now locked in as of September 30th. It actually notched down another point there, and it was actually above that blue line as recently as a month ago. So we've taken a pretty good hit over the last month to 6 weeks, and I'm ready for us to start going the other way now. But I just love the quote down there at the bottom. You guys can read that for yourself. I really think this captures the essence of the extended community that is out there with investment clubs and anybody who has spent any time touching any aspect of our broad community. Your thoughts, Ken?
Absolutely, Mark. I always like to talk about doing our analysis with an eye towards the negative and hoping for the positive. It seems to have worked for a lot of years for me and for you, and I know that if you do it with a lot of discipline and some patience, that it'll work for most of the folks in the audience as well.
And if nothing else, you've got a shoulder to cry on when it doesn't work out so well. All right. Real quickly, a couple of departments or segments that we often check in on. Here's the Groundhog Challenge update as of last Friday. And it's the top 40. There's 171 contestants in this year's battle for the championship of investing rights in the world. And those guys up at the top there seem to be kind of toggling their positions around. A lot of very familiar names. Notice that Herb is lurking near the top again. Ken continues his ascent. And I think you pointed out that the Wolves are on here again, Ken.
The Wolves, which the portfolio that they send into the Groundhog is made up of their best performers. So the Wolves' best performers have made the top 40 and a positive return in a very difficult market. I'm pleased with that.
Yeah, and there's some longtime powerhouses on here. Bower City is on here. Our two-time defending champions from Space Coast down in Florida are lurking also. So good, clean fun. It's been another rough year for the group in general. And I did want to point out that our special guest Ty has an outstanding 8-year track record in the Groundhog. Unfortunately, and he's asked us not to talk about it, it's not the case this year.
No, not at all this year. I'm down near the bottom.
It happens. It just happens. And it's one of the things that we'll actually talk about here in a minute. Sometimes no matter what you do, you just get kind of snake bitten or whatever. And in fact, in general, as we point out in the middle of that box on the right, the Wilshire 5000 is actually just barely positive now. I can't believe that it's shrunk so much here so quickly. But the value line arithmetic average, which again is going to be a composite of small, medium, and large companies. So it mimics a lot of what we do in our community of investing. And by golly, you take a look at that number, it just says if you're having a rough go of it right now, you are not alone. A lot of the people who follow our style of investing just might be struggling a little bit. Just hopefully not struggling as much as the monkey. So anyhow, we'll come back and look at this again next week, and best wishes to everybody. Hope everybody does well. Real briefly, I wanted to check in on this one because I think it makes one of the strong points for today. This is our best small companies that we pick on Halloween every year, and we keep track of them for the next 12 months. And we've had better years, Ken. I don't know how many more rabbits I can fit on this screen to get the right number of rabbits feet for. We've only got 4 weeks to go.
Maybe our strategy changes for next year, Mark, and we don't show this screen every single week. What do you think?
Well, I suppose there could be some evil hedge funds out there that are just having fun with us. I doubt it. Anyhow, we have 4 really good ones. A couple of them are off the charts good, but there's way too many that are not doing so well. So there we go. But one of the reasons I wanted to include it today is this notion of longer term perspective, and it's particularly true for a retirement plan or retirement plan considerations. In this notion of being able to do this every once in a while when things just don't work out. Now, Ken and I started doing this many years ago. We switched to a full-on, George Nicholson inspired approach back in 2015 when Forbes abandoned their best small company list. And we proceeded to run up a 7-year track record, which was simply en fuego, on fire. And then last year, not so much. And again, this year, not so much. And it makes us angry. It makes us disappointed, but we can shrug. Are you shrugging, Ken?
No, I'm sitting here listening to you justify our last 2 years. Go on, Mark.
It's just how they have kind of stunk up the joint the last 2 years. But when you put it in context, including the bad year, you're looking at this, and that I'm not sure I'd be able to get out of bed if I didn't have that to fall back on when times get tough. So that is the power of being able to appropriately shrug. I expect, one of these years, Ken, we're going to beat the market again.
I think so, Mark. I'm confident that it'll be this coming year. All right.
Okay. Does that mean that you're going to have more yellow cards and red cards when we pick the stocks or not?
I might. I don't know. Might have to veto a few more. Okay.
I'm not sure who we can blame for those, but Kevin Galogly blames me for Portillo's, and might have to double down on Portillo's. All right. Anything else you want to cover before we get into it?
No, I think this is a great slide to start this going here, so let's get underway.
Okay, we're about 10 minutes in, so we're making pretty good progress. We're going to talk about this Thrift Savings Plan. Again, this was a program we did approximately 10 years ago, and it was extremely well received, at least in giving some advice from 35,000 feet for participants in this program. And Ken and I have both talked about this a number of times. We think that the plan is outstanding in the opportunity it provides, and we're just glad that Ty is here to pick it up and update it alongside us. So good stuff. What I thought we might do for a few minutes is spend just a little bit of time talking about the general status of retirement plans in general. And this is just a couple series of slides about what's been kind of going on. And the one that kind of jumps off the page here at me, and you'll see this a lot if you go and try to do some Google-based internet research, a lot of times you run into fairly dated information that you see here. And there's not a whole lot of very current information. I found that kind of stunning. But you can see that in general, people would wish that they would have a little bit more. It is refreshing to see the number of people having a plan kind of going up over time, but it's always possible to do a little bit better. But again, a lot of the information is a little bit dated. One exception to that is the Transamerica Center for Retirement Studies. They are current, and they have annual reports going back probably a couple of decades that you can actually look at online. And I found it kind of interesting to see what the average contribution or set aside is for these generations. And part of the research that they featured was that we actually see some of I think the next generation above millennials or younger than millennials is Generation Z. Am I correct in that?
I think you're right, Mark.
It's not shown on this slide, but the Gen Z people are being given credit as a collective cohort of actually seeming to set aside more for retirement planning, and that will work pretty well in their stead. And by the way, the difference to go from this number down to this number is something like 6%. So it's definitely something that's achievable. I think the 289 needs to be higher too, but after all, as we joked yesterday, Ken, I think you have that much in your wallet, right? Well, not exactly, but you know what
Continue.
just continue. All right. One last slide just to basically make the point that things are better than they have been, but any incremental improvement that can be made in terms of the amount or the level of success experienced by all of this, there's the Generation Z pointed out on here, is a good thing. So again, I'm optimistic that this situation will improve over time just by the general attitudes we see on display. And the turbulence over the last couple of years didn't do as much damage as many people thought that it would. Any other comments you'd like to share on this, Ken?
Just that I'm surprised that at the point we are in life that only 38% of the baby boomers feel that they strongly or somewhat agree that they have enough saved for retirement. That tells me we still have some active savers in my generation, and I'm wondering where they were the whole rest of their life. It pains me to think of the people that I worked with that had virtually no retirement saved at the point that they left their job, and they counted completely on a teacher's pension and then later Social Security.
Mm-hmm.
So it's if you can save now and you're young, save. That's all I can continue to tell my grandkids, and that's all that I can continue to tell our audiences.
Well, I keep talking about you adopting us, Ken, and our answer to this question largely depends on whether you and Natalie decide to adopt us or not. But all right, enough frivolity. And with that, let's go ahead and dig into the specifics of the Thrift Savings Plan. And again, welcome, Ty, and just so pleased you're here to share your personal experiences and observations about what this opportunity presents for the people that have access to it.
All right, well, let's get started. I had the good fortune, I spent 20 years in the military. We didn't have the Thrift Savings Plan available when I was on active duty, but then I went back, worked for the Air Force for about 9 years, and I was able to start the plan. So that's what got my interest in it. The Thrift Savings Plan is a retirement savings and investment plan for federal government employees and also members of the uniformed services. And for those in the Ready Reserve, it includes them as well. Congress started the TSP program in 1986. I think it was at the time that the Civil Service Retirement Program was modified, and instead of going from an entirely defined benefit, it was split into defined benefit and defined contribution, and that's when the TSP was started. It's very similar. The TSP is similar to the same types of savings and tax benefits that private corporations offer their employees under their 401k plan. Importantly, the TSP is a defined contribution plan, and that means that the retirement income you receive from your TSP account will depend on how much money you put into it during your working years, as well as the matches and then the earnings that they accumulate over time. To Ken's point, that's the key. That's the whole key to it. Start early and invest regularly. TSP has a very good participation rate. It's 95%. And another advantage of it is once you have a TSP account, even if you only have served only a few years in the government or in the military, you can keep your account open for life as long as you keep at least $200 in it. And I'll talk about the advantages of that, because you can move money from qualified plans into or out of the TSP. So the slide in front of you now, it just essentially summarizes. This is very similar to what you would see in a 401k plan. You have the option for a traditional TSP, which basically reduces your taxable income at the time, because those contributions are taken off your income. But then later on, when you take the money out of the TSP, you have to pay income tax on those contributions. They also now have a Roth TSP option, and you can do any combination of the two. You can do all traditional, all Roth, or some mixture. Another aspect of it is the matching by the government. You see on the slide here, if you can get up to 5% match on what you put in, there's a little bit of a nuance here in that you have to space out your contributions over the year, because the matching only applies to whatever money you've earned for that pay period. So if you were to try, you can't front load a TSP like you can an IRA, because the matching, the 5% match is limited to it's capped at whatever you have for a particular pay period. So most people try to space out their TSP contributions over the year to maximize the matching. The fees are relatively low, 5 to 9 basis points. And I'll talk a little bit more about that later, but that's consistent with the very low cost index funds that are available from Vanguard and other providers. There's a couple of other aspects of this. There is a TSP mutual fund window. So you can buy regular mutual funds through TSP. It may not be that advantageous because there's a minimum of $10,000 to start it, and then there's an annual maintenance fee of $150, and then there's also a $28 per transaction per trade fee. So it may not make sense to try to buy regular mutual funds through the TSP, although if you want to, you can do it. And then there's some benefits for spouses, which we'll talk about later. I think of course, there's automatic payroll deduction too, is another advantage. Okay, so next slide, please. So we talked about traditional and Roth accounts. The TSP is made up of basically 5 index funds. They cover, for those of you who look at asset allocation or very, very broad diversification, you get that through the TSP funds. It's got two equity funds, actually 3 equity funds, 2 US funds. It's got a large cap, which is like the S&P 500. And then you've got a small cap fund, which is basically a completion index, which is, we'll show you a slide when it comes up here, but it covers an awful lot of small and mid cap stocks. But the advantage is with those 5 index funds, as we'll talk about later, you can build almost any type of asset allocation that you want. And then they also offer, taking the 5 funds, and we'll show how this is done, they offer 10 different life cycle funds. So you can buy a single fund and the asset allocation will slowly change over time to hopefully meet your needs. And the thought being that as you get older, you want a little more money in fixed income than you do in equities. And that's what the life cycle funds accomplish. You see the limits here, it's pretty substantial. I think it's the same as the IRA's, $22,500, and then a catch-up contribution if you're over 50. Current government employees, not separated government employees, can borrow up to 50% of their TSP account. And what's very interesting to me is you pay interest on that at the G fund rate, but the interest goes back into your account. So it's I was trying to think the logic and why they did that, and I guess it makes sense in a way. So they have 2 categories of loans. They have a personal loan, which you have to pay off within 5 years, and then they also offer, if you're going to buy a house, you can get a longer term loan that goes from 6 to 15 years. The only downside is if you become delinquent on the loan and paying it back, then it converts to income at that point, and it's treated as though you made a distribution from the TSP account, and you have to pay taxes on it as income. So again, it's a special case, and it may benefit some people to be able to, say, for example, make a down payment, but it's only for current employees or current military. One other thing most people may not know is you can roll a qualified plan like an IRA into a TSP account. So let's say you had a relatively small account, you worked for the government for a few years, or maybe in the military for a few years, and you have a few $1,000s in your TSP account. If you want to take advantage of the TSP, you can roll money in as well over time. And we'll talk about it, the distribution options, either rolling the money back out into an IRA or taking a distribution, are very flexible. They made a lot of changes last year to the program, which greatly improved the flexibility for people in the program.
Yeah, there's a lot of incredible flexibility with this thing. It's cool.
It does offer a lot. Now, a couple things. You can't do a qualified charitable distribution from a TSP account, but there's a simple workaround. You can simply, if you're inclined to make a charitable, a QCD, qualified charitable distribution, you could simply move some money out of your TSP into your IRA and then make the QCD from your IRA. So there's an easy workaround. There's also automatic withholding by regulation. So if you take a distribution from it, from your TSP account at some point, say you're over 59 and a half and you want to take a distribution, there's a 10% required minimum distribution. And also when you take your RMDs, there's a mandatory 20% federal withholding from that. So there's no flexibility on those two. But something I found out I thought was very interesting. If you do, the money withheld from an RMD is deemed by the IRS to have been spread out over the entire year. So if you were to take an RMD at the end of the year and there's withholding on that, that withholding is deemed to have been made over 4 payments in the year. And this is significant if you're in a situation where you have to make estimated tax payments over the year. You can satisfy those estimated payments by making the withholding in the toward the end of the year from your IRA or TSP cover those withholdings. So of course you don't want to wait too long in the year to do that if something goes wrong, because there's a penalty if you don't get the RMDs out in time. But it's kind of a neat aspect, because then your funds can earn. Hopefully the market goes up during the year, but your funds are earning for the whole year up until the point of the RMD, and then of course you can designate how much you want withheld from that. In TSP, it's a minimum of 20, but you can go all the way up to 100%.
Ty, we have a lot of interest in our audience about who exactly can participate in the TSP. Could you clarify that again for us, please?
Sure. It goes with either federal employment, you're a federal employee, or a member of the military or the uniformed services. For example, the Public Health Service is a uniformed service. The Coast Guard is a uniformed service. So any of those categories, and it's normally an option that's made available to you when you're in process to those organizations. Unfortunately, you cannot, if you don't have that connection, it's not open to you.
So if you worked in an office building for the Department of Agriculture in Washington, you could participate in the TSP then?
Absolutely. And the new rules, they automatically start you in the TSP now. They take some percentage, and I think they put you in the life cycle fund. So there was a change in the rules on that. So when you have to opt out now, you're automatically opted in, and you would have to opt out. So if anybody is starting with the government, they'll automatically be enrolled in the TSP.
Thank you so much.
Yep. So here's a couple these tips for participating. These are not really TSP as much as they are just common sense for long-term investing, but they apply to TSP as well as to IRAs or 401ks or 403bs. Start early. That's the biggest thing you can do. You've all seen the graphs over, starting saving a certain amount at age 21 versus starting at 30 or 40, and it's just amazing the compounding effect of starting early in life, contributing regularly. I think we all know that. And the last point on here, I would say, please be sure to review your beneficiaries periodically on a TSP or an IRA or a 401k. Most people know that your will does not govern those distributions. They're governed by the beneficiaries you name in the plan. And so as things change in life, you should be looking at both your will and your beneficiary designations on any of your qualified plans, because even if your will says I'm leaving everything to my wife or I'm leaving everything to my children, when it comes time to distribute an IRA or a TSP, they're going to look at the beneficiary designations that you made with the plan, and the will have no effect on those. Next slide, please.
It's a good point. I actually went through the experience of having so much covered by the family trust, but then did run into one IRA account that had a little bit of difficulty, and I had to do a lot of gymnastics to iron that all out as one of the beneficiaries. Well, this is just basically a little summary of what we're going to try to cover. Si's already hit the high points. We want to basically talk about the cafeteria menu. We'll talk about dashboards as we deploy them at Manifest, but basically just go through some of the highlights and be happy to answer any questions as we go.
Okay, why don't you pick it up here, Mark?
Yeah. Here's another one, just a little bit of performance perspective over the longer term. We're going to actually talk about specifically what is in these TSP funds. But you can see the top three are stock based, and they're benchmarked against the Wilshire 5000. So again, this is the benchmark. So we're going to be talking about how they have performed over time. Going to take issue with this one a little bit. It has not performed quite as well as many people would have hoped. And then Ty has quite an infatuation, Ty has quite a respect, admiration, and infatuation for the G Fund, and it's really, it's a wonderful thing if you have access to it, without a doubt. So that just gives you a little perspective on the type of performance, and you can see these are just fine over the long term. And in fact, we can get Ken to talk about his respect and admiration for simplicity.
Yeah, this is where you can see with these 5 funds, the name, the letter almost designates what they are. I'm not sure where the F and the C came from. S came from small and I international, but I don't know where they got the C and the F. Who knows? But the advantage here is that these are very clean, well-diversified funds. I would think, Mark, in the small cap fund, there's probably how many thousands of stocks do you think are in that index?
Well,
the completion index.
The completion index is about 3,700 stocks, so it's the major stocks that are outside the S&P 500.
Yeah.
They got 501, 3,700 in the S, and we'll actually get a peek inside that fund to see what that looks like. And
the I fund, I think, is comparable to the S fund in terms of the number of companies in it, because it includes
a lot. Yeah, it's a lot.
Yeah, it includes developed markets, small, international, and emerging market as well.
Most of the companies in it are pretty well established, though, very mature companies for the most part.
Yeah.
All right, so we'll just keep pressing on.
Yeah, so this is going to be probably the longest slide I talk about. This is the most interesting fund, and what I think it makes a compelling case for keeping your TSP account open and not closing. And a lot of people like to, and for good reason, like to simplify and consolidate their investments and holdings as they get older. It makes perfect sense. But the G Fund has some very unique properties. It's first off, the fund never loses principal. It never goes down in value. That's one part of it. And the second part of it is the interest rate, the yield on the G Fund, or the interest rate that you receive from your TSP G Fund, is about the same as intermediate term treasury bonds. And so how do they do that? I spent a little time researching this, and it's actually pretty interesting. The Congress gave the Treasury Department, actually directed the Treasury Department to make non-marketable securities, a special non-marketable security available to the Thrift Savings Board. And so what they do is they have basically one-day securities that are set, and I'll talk about how they set the interest rate, but the TSPG fund basically turns over every day these one-day special securities that are made available by the Treasury Department. And that has a lot of advantages for the fund. It helps them manage their liquidity on a day-to-day basis. But the other interesting part of it is how they set the interest rate on the fund. So they compute it every month, and it's based on a weighted average yield of all of the outstanding marketable U.S. Treasury securities with a duration of 4 or more years. Now, I don't know who has to figure this out in Washington and how they do it, but the magic is when they do it, they're coming up with a composite yield for the G fund, which is probably in the vicinity of maybe a little higher than a 5-year treasury is what I estimate. I could not find anything more specific than that. But the concept is they come up with the interest rate, and then the fund is basically buying one-day paper, and so there's never any interest rate risk on that because they're buying it one day and selling it the next. The longest they hold any of these special notes is either over the weekend, which could be 3 days, or maybe a 4-day weekend if there's a holiday in there. But that's it. It's normally every day they buy and sell those, and so there's no downside risk on it. There have been a couple of, I will say, I do remember last year there were some folks who were concerned that maybe the government was subsidizing the TSP a little bit by making this available, and that's probably true. But anyway, there's nothing comparable to this on the on any of the other money market funds that are available elsewhere. And then as we move through this, I'll show you some slides which show you how this rate compares with short and midterm rates. So in summary, the G fund provides an interest rate very close to an intermediate treasury security, but with no risk of loss of principal. In other words, the daily price for the G fund never goes down.
Fascinating.
So this is the 90-day T-bill rate compared against the G fund. I will get to this in a little while. There's with the yield curve inversion that we're experiencing, there's been a little nuance here, a little anomaly that we'll talk about. But by and large, over time, you go back to when the G fund was started authorized back in 1986. You can see that it's always done a little bit better than the 90-day T-bill rate. And then to satisfy your curiosity, I'll show you a slide which shows you how the 90-day T-bill rate corresponds with inflation. So, next slide, there we go. So here's this is from the Federal Reserve economic data database. These are available online if you search for FRED. They got some great graphs. But basically this shows an overlay of the what they call, that's an interesting term, the sticky price consumer price index, less food and energy, and that's overlaid against a 3-month treasury bill. So what the Federal Reserve does is, the reason they use this sticky price index is they take out the most volatile components of the consumer price index, because they feel, and their data shows that by removing those, they actually get a more accurate picture of inflation over time. And what this graph shows is that inflation and 90-day treasury yields kind of are tracked pretty closely. They're pretty closely correlated, not perfectly correlated, but they're closely correlated. Okay. Now, why is the G fund advantageous? Well, let's look at the 5-year treasuries and inflation, and what you can see is that for a lot of the periods shown on the graph, the 5-year treasuries has beaten inflation, in some cases by a significant number of points. So if you're holding the G fund, history shows there's a very good probability that G fund will stay ahead of inflation, not just meeting inflation. And that's the point of this graph. Okay. Now here's what I was talking about. This is the one little anomaly when I was preparing for this presentation, that there's actually been a yield curve inversion. I know you hear everybody talking about this on CNBC and other places about the yield curve inversion. Historically, a yield curve inversion has always signaled a recession is coming, but in any event, we're about a year now into this yield curve inversion. And so what's the impact of that on the G fund? Well, remember how we calculate the interest and yield on the G fund? We're taking the average of the weighted average of Treasury securities with more than a 4-year duration. So the G fund interest calculation is really more in the range of around the 5-year treasuries. So what that practically means is that right now, today, the 5-year treasuries are yielding 4.7%, and the 3-month treasuries are yielding 5.51. So there's about 74 basis point difference. So meaning that today, whereas in the past, if you were holding the G fund, you would have beaten the short-term treasuries. Today, you're just a little bit behind. There's been a discussion, those who read the Bogleheads forum, about whether it's worth switching from the G fund to short-term fund to close the gap on that 75 basis points. I personally think that may be a lot of work, but I guess if you had a lot of money tied up, it will be worth it.
Okay.
Okay, Mark, over to you then on these. You did these nice graphs.
So again, as Ty has described it, I refer to it as a money market on steroids. It's a spectacular investment, probably the true risk-free interest rate if you think of it in those terms. And this is just to give you a little perspective of over time how steady and how reliable it has been. And of course, with the increase in interest rates that everybody knows about, we are actually headed probably back towards this range this year. So we're back at levels not seen for the G fund since back before 2008. We're already at 4% trailing 12 months. So going to end up somewhere up in that range. And you can see over the long term, we're basically talking about a 4% very steady and reliable investment. Like I say, a money market on steroids. It's one of the most beneficial features of the TSP from my perspective, and probably explains Ty's infatuation. Anything you want to add to that?
No, I think, and this next slide, comparing it to the F fund, I think is important.
Okay, back to you.
So the F fund is it's the Barclays. Help me out here, Mark. The Barclays.
Yeah, it's just the Barclays fixed income, shorter duration type stuff, or I should say intermediate. The one that's actually used, we're gonna look at the analogs here in a few minutes, but I think it's AGG. We'll actually show that.
Yeah, and this also is roughly equivalent to the people that hold the Vanguard Total Bond Fund. I think
Yep.
It's that fund is it's got a significant government component, not treasuries necessarily, but agency securities, and then relatively high quality corporate paper. But for a long time, the F fund and the Barclays were AGG were considered the gold standard for conservative. If you wanted to put some money into the bond side of your portfolio, that was what a lot of folks recommended. And if you see from the next slide, go ahead and flip forward here. The real downside, and this is look what happened in 2022. That was the year that everybody's equities went down and everybody's bond funds went down, and that was quite a shock for a lot of people. So that, to me, that's one of the fundamental differences here: the F fund and the G fund. Over the long term, I should have done this calculation. I didn't. I don't know that over the long term the F fund does significantly better. I don't think it does, but it's clearly more clear, maybe a little bit better, but it's clearly much more volatile.
Yeah, and that's the perspective behind that opinion on the previous slide. A lot of people think of these type of fixed income investments as relatively, in comparison, risk-free, and they're anything but that, as we saw here. And we were talking recently about how anytime that there's been a tremendous challenge in the market, like 2008, 2002, or whatever, a lot of the asset allocation and the theoretically safe zones were anything but. And this really puts it in a pretty stark relief, especially when you look at what it did to the long-term balance of $100 since 1994. So not risk-free by any measure, and I'm sure the Bogleheads have had a lot of fun with this one.
Well, the big question people have is, do they jump back in now? Because when you look at the bond funds, I think this Barclays had a duration of 7 years, and so that means every point that interest rates move, there's going to be a 7% move in principal amount. So that's the great question. Are interest rates going to go up or down? If they're going to go down, you want to jump in. If they're going to go up, you want to jump out. But who knows? Who knows what
Yeah,
they're
and
going
there's
to do?
already been a fairly substantial recovery year to date compared to the bottom side of that 2022 graph, bar in the graph. So yeah.
Yeah.
All right, so on to the C fund. I wonder what C did stand for. We've got to find somebody who can tell us the answer to that. I'm going to go looking. Either Len or Kevin Galogly can probably figure that one out. Anyhow, did you want me to cover this, Ty?
Yeah, you go ahead. Yeah, you can
Yeah.
talk through this. Sure, please.
Well, again, in terms of the type of options that you have on the menu for a TSP eligible employee, this one's a good one. I mean, this is the S&P 500 over time. It's going to have all the natural volatility of the S&P 500, but you're investing in the largest domestic U.S. companies. And the rage right now, and we've talked about it a few times around here in recent weeks and months, is this notion of the Magnificent Seven. And Ken will probably chime in with the Yul Brynner and Steve McQueen and whoever else was in the Magnificent Seven and how he knew them all personally. But the top eight companies there account for a large component of the overall performance of the S&P 500 index. And in fact, you do the top, I think the top 10 gets up to almost 30% of the index itself. But a lot of very familiar names up there, even beyond the Magnificent Seven.
Mm-hmm.
And here's a look at it over time. Again, the takeaways here. Obviously, there's going to be volatility. You're going to have 2002. You're going to have 2008 from time to time, but you also have these up here. They all add up to something right around 10%. You can see this year it's 13.3. So you are investing in the bigs. The fact that the tech sector got hammered, notice the amount of tech stocks up here in these magnificent stocks. They got hammered, so we ended up with this pattern here. It's actually bounced back quite a bit this year, and but the long-term average is in that 9 to 10% range.
You know, the one thing I guess that strikes me about these charts, the C fund, the S fund, and the I fund, all of the equity stocks, is the when you look at the by year volatility, it's up and down, and that's been like that for a long time. Then you look at the graph on the right, it kind of steadily grows, and the key takeaway, and I have to admit from my own mistakes that I've made over the years, is when you have those periods of volatility and you try to time the market, I think it's impossible to do that. So if this becomes index funds become a core part or a significant part of your portfolio, or even insignificant part, the key to success in dealing with these funds, because you've already got the diversification just based on the number of companies that are in the index funds, is to don't try to time things. Just, to dial in your whatever asset allocation you think fits your needs and leave it alone over time, and let the money compound. When you try to move in and out on these ups and downs, I don't know anybody who's been successful at it.
Guys, I have what your C stands for.
Okay.
Thanks to two of our fact checkers in the audience. C stands for common stock.
Oh,
Okay.
Should have been a first guess.
Thank you for that.
Common stocks. Okay, so now we can remember that. All right, so let's press on with the S fund. This one's a little bit friskier, but it's one that, again, I'm coming at this from my personal perspective and what my perception is of the perspective of our community. And we recognize the importance of having small and medium-sized companies in our portfolios. As we'll discuss here in a few minutes, it seems to get a little bit of short shrift from a lot of the experts and a lot of people that are doing the deployment of this stuff. But we really do believe that the smaller companies, as signified by our red rabbit, we were talking about hugging the rabbits earlier a few minutes ago, and then these workhorses. And in fact, those workhorses are so important. We think that anywhere from 40 to 60% of our equity portfolio should be in those workhorses. I would encourage you, this presentation that we made with the St. Louis chapter is a pretty good one if you want to get a little bit more background on it. But the companies that are in there, there's some relatively newer names, less well-known names, a little bit farther off the radar or off the track. But these companies have done pretty well. And these are going to be the top performers because they're at the top of those 3,700 companies we were talking about. So these are the top, many of the top performing companies over the last year. Notice some of these numbers. That's pushed them to the top of this cap weighted index. So pretty good over time.
Mark, I also think your data shows that picking companies in the small and medium company category does substantially better than just buying an index in that area. I mean, I think you've made the case very strong with the tin cup portfolio, and I think applying the better investing methodology to the universe of small and mid cap companies, I think, can yield a much better result than just holding the index.
Yeah, and in fact, we talked about it a little bit with Jeremy Grantham in the last couple of weeks, and this notion of if there is a drawback to these five, and again, I think the TSP is elegant and wonderful, but if there is a little bit of a drawback, it's that you are stuck with, all the good and bad companies in these indices. And one of the things that we know in our hearts is that you can identify quality companies, again, better companies at better prices. So you can actually take a little bit of the chaff out of these, and it can be done, and it can be worth a few percentage points. So just something to think about. So here's the track record of this S fund investing in what we refer to of all of the above with the big companies removed. So it's small and medium stocks. You can see that same type of general volatility. Again, checking in at an overall rate long-term of double digits. And again, year to date, after a little bit of a rough year last year, checking at 9% this year. So it does have that dip, but pretty good recovery so far this year. And again, that long-term trend coming in somewhere at the 9 or 10% level, and or 11%. And as Ty said, pretty tough to time these gyrations, and would probably recommend that we not do that. I did throw another slide in here, and this is, Ken, you were talking about how this probably makes a pretty strong point. If you're thinking about risk, we think about risk completely differently than average investors, but this is kind of the way we think of risk, assuming that you have some time. Anything you want to add to this, Ken?
Well, I think we should explain the graph real quickly. The bars represent a 5-year period. So when you're looking at the 2010 bar, you're actually looking at the years 26, 7, 8, 9, and 10. And you're looking at the performance over those 5 years for any one of the particular bars. You go back 5. And they're all positive. They go back to 1998, which takes you back 5 years before 98 starts or 98 finishes, and they're all positive. If your time horizon is long enough, then your risks of losing money, and that's where I begin to see a risk when I'm losing capital, your risk of losing money begin to diminish. We know that if we do these same kind of charts at 7 years or 10 years or 15 years, even longer time spans, we know that the positive numbers increase, the size of the bars go up, and it becomes an even, I hate to use the word safer, because within any time period, there's a period where you can lose money. But overall, if you are patient, the possibility of losing money reduces itself to a very small probability.
Yep. So if you've got 5 years, the risk is something different than most people think about. All right, let's press on to the iFund. And this one gets my dander up a little bit here. I'll try not to get too far onto the soapbox, but the I fund, it's a great idea to consider these type of companies in an investing regimen. But again, I would urge the consideration of better companies at better prices. And the narrative here just kind of rubs me the wrong way just a tiny bit, because I really don't believe it's accurate enough. It's not the best approach to diversification that I've seen, and we'll take a deeper look at that. Sorry if that was a little harsh, but
no, I agree. I agree with you on this, Mark. And the I fund is 20 developed countries. It is not the whole universe. I mean, there is a school of thought out there that investors should hold the investing everything, stocks from around the world. But there's a lot of folks who disagree with that, like you do. John Bogle, when he left he famously left his wife the S&P 500 and a money market fund, and said, I don't see a need for international stocks. And I think Warren Buffett has the same view, although he invests in foreign companies from time to time. But I think that's right. I think there's a lot of volatility here, and this is a great debate. If Boglehead's forum must have thousands of postings on this. Do you have, should you have an international component in if you're going with this indexing approach? And people come down on both sides of this. The last 10 years, international has not done very well. It runs in cycles, it seems. There were some years when it did a little better.
Yeah, but the cycles have been less prominent in recent years, and that's kind of what's shown here. I mean, the long-term average, again, is down in mid-single digits. That's a very important number to keep in perspective. Notice that it has all the ups and downs, if not more so, to the upside and the downside than the other two equity funds. And again, the long-term average is down closer to 6%. A little bit better year this year, but that's after, a couple fairly catastrophic years in recent history. So, I think a lot of the advice coming from the advisory community out there is leaning on some theories that haven't necessarily proven out very well. And we've talked here at both sessions about this notion of an efficient frontier, and how it's kind of tough to even find information about it because it just doesn't seem to be panning out very well. Notice the scale change here, and we'll take a look at it in a different. Here's the two side by side. They look like the same shape, but look at the scale on the two.
Mm-hmm.
So I'm having a hard time with justification here.
Yeah.
Mark, do you think that the last 30 years, or maybe even 40 years, has made U.S. companies much more competitive worldwide and moved them from doing business basically in North America to doing business throughout the world, and therefore given us the opportunity to be pretty diversified by buying good, solid worldwide companies based in the U.S. as opposed to going overseas and looking for index funds?
Well, Ty, I'm pretty sure the Bogleheads would largely agree with that, with some exceptions.
Yeah, no, I think that's Ken. I think that's 100% correct, and I think I think John Bogle made that comment a number of times. Just that when you're buying many U.S. companies, look at the amount of revenue they generate from overseas.
Yep, without doubt. Ken Janke used to talk about that too. The other thing I will point out to the audience, though, this is a great shopping list. If you're going looking for investments, there's some great companies on there. I personally hold Novo, and quite happy with that one over time. And there's a couple others on there that have been quite good. So don't take that all the wrong way.
Well, and I will admit to owning ASML as an individual company, as an individual stock, Mark.
Mm-hmm. Mm-hmm. So good stuff. Just something to think about. So if you want to actually do some quick comparisons, here's the one you were asking about, Ty. The Vanguard Total Bond actually goes by this ticker now, AGG. So 4 of the 5 funds, the 3 equity funds and the F fund, actually have analogs that are available out there for tracking purposes. The lifetime funds all do. I just didn't put them here, just left them out. But this is that special case that there is no publicly available ticker to look at. Now, this is the closest, one of the ones that comes fairly close to it, Vanguard short term. But those are the stocks you can actually refer to. So one of the things I wanted to do is just remind the audience, if you're new to what we do, and there's not many new people here, but there are some, we basically characterize all funds, including the ones we've been talking about here today, by looking at their pieces and basically coming up with a weighted average of all the components. We look at the quality and the return forecast. We're not going to go into those. You can follow along with us at Manifest Investing if you want to go into a little more depth, but we believe that the quality, the return forecast, and enough growth are important. That's these three components are down at the bottom. And we basically use those to characterize any investment. And we pay a lot of attention to the track record and where they seem to be headed. So one of the things that is available to you that you can do is you can actually build a dashboard with the TSP. The thing I would encourage you to do is use the worksheet function on Manifest. If you need more about that, let us know, and we'll make that part of a future presentation. But you actually enter the balances in, and then just enter the ticker for the analog, and you can very quickly generate this. It takes about 30 seconds, maybe 2 minutes, to generate an analysis of your TSP holdings in this format. Again, since these are not publicly available prices, we do have to use this workaround, so we're actually back calculating these shares, but it's these numbers that matter, what's on your statement, and you can actually characterize your investment over time.
So let me talk briefly. This is just an illustration of how you can take TSP funds and build any type of core portfolio that you want, and you have to decide on the asset allocation you want. But I'm not advocating the 60-40. There's been a lot of discussion. The 60-40 did not do well when the market had turned down year before last. Some people are saying it's back. I don't know. I think when you set up a portfolio, whether it's with TSP index funds or other index funds, there's really three questions you have to ask yourself. The first question is, how much do I want to have in equities, and how much do I want to have in bonds or cash equivalents? That's kind of a core question, and that has to be answered in the context of your whole portfolio. When you've answered that question, and that, by the way, that can go all over the place. That can go from 90-10 to 50-50 to 40-60. It just really depends on your personal situation and your need to have access to cash equivalents. And the next question you have to ask is between U.S. and international. Do you want an international component or not? And that's an easy one, yes or no. And then if you get into international, it gets even more nuanced. You've got developed markets, you've got small cap international, and you've got emerging markets. A lot of people advocate that it's really not a helpful part of the portfolio anymore. I tend to subscribe to that view. I do subscribe to that view. And then the other part, and we talked about this a little bit earlier, is, okay, now you've got the U.S. stock component. How much large cap and small cap do you want in there if you're using index funds? And so that's the if you want to mimic the total market, you would need about 22% of the S fund and the rest in the C fund to mimic the total market. But again, a lot of people like to have a small value, a little heavier component. They call it a tilt, and some people even add value, which is not available in the TSP funds, to the small cap value to that calculus. But the point is, the TSP allows a lot of flexibility, and we're going to talk here in just a minute. If all of this makes your head hurt in terms of trying to figure out the asset allocation, there's another option. So why don't we move forward? We'll get to your next slide, and then we'll jump into the life cycle funds.
The stuff on the right is just a reinforcement why we feel so rigorously about, if you look at over the long term, the blue chips, the C fund is right down here, and the S fund would be these two. So we feel pretty strongly about having an appropriate amount of commitment to the S fund. And again, we just throw up a question mark on this one. And keep that in mind as we look at some of these other allocations.
Mm-hmm.
Okay,
that's a great point.
I'm just showing one of the workshop entries for that, so we'll just go ahead. We'll press on with the life cycle L funds.
So this is, I guess, a relatively new feature. It's offered by TSP. It's also offered by Vanguard and others, and it's essentially for people who want to invest with an index fund base, what funds do you put together? And the TSP happens to use the 5 funds, the GFCS, all of them kind of together. Their expense ratios are really low for the life cycle funds, 6 to 7 basis points. In comparison, Vanguard is very cheap too. Vanguard is 8 basis points, so it's not. And please don't get too concerned about 1 basis point. If you have $100,000, it's going to be $10. So it's not a lot of money to worry about. 10 basis points might be more concerning. Here's how it breaks out for the funds. There at the bottom there, the date is when, like 2065 on the left, that's when you anticipate you would be tapping into your fund. That's kind of how they organize these. And as you can see, they've got the bulk of the portfolio in the S&P 500. They've got a pretty significant amount, the I fund, 35%, and then the 14% in the small cap fund. So this may not be the asset allocation you want. This is what the people at BlackRock and the Thrift Savings Board have decided is the optimal solution for the most number of people. They typically put when somebody joins up and they have their initial mandatory, they automatically enroll them. They start them out on one of these life cycle funds. This may or may not fit you. So next slide. This just shows the point of the life cycle funds is that they continually adjust over time. So you start out first couple of years, you're heavy in equities, and then it starts moving into the G fund and the F fund over time. And the advantage of these life cycle funds is if somebody doesn't have the interest or time to manage the money, it's a good way to put the retirement account savings on autopilot. It may not be the best way, but it's better than not doing anything.
Oh, it's definitely better than blowing in the wind for sure.
Yeah, and this is just the allocation of the income fund. Again, we talked about the G fund. I'm kind of a fan. I don't have a big problem with having a substantial amount in the G fund. If your goal is to get to retirement with a pot of money and you want to protect it against inflation, this accomplishes that mission.
Okay, and here's just this is just an editorial observation. I've seen this with a number of people and working with the life cycle funds, either the private versions or the TSPs. Just want you to be aware and mindful of how little differences make a big deal. If you walk in the door and you're only a few years away from retirement, they might put you into the 2030 fund. And but if you really have a life expectancy, which is basically out here a few more years than that, what I want to point out is this blend up at the top versus the blend at the bottom, basically taking the 2030 versus the 2055, it adds up to an expected return difference of about 2%. So again, going back to that Transamerica slide earlier on, if you got that $289,000, if you invested in the top set of stuff and you achieve 8.1, you end up with 900,000. If you invested in the stuff down here at 10% per year, it actually comes in at a little over $1 million. I don't think that's inconsequential. And again, the only reason we bring this up is small differences in how you set these things up make a big difference at the end of the road. And if you're confident and understand the long-term perspective, we just basically think that most of the asset allocation models that are out there just might be a little bit more conservative than we would appreciate. For our personal situation, took many of our funds, which were 2040s, and put them out to 2070, just so we would have a larger equity exposure for the life cycle funds that we actually have in our family. So again, small differences make a big difference.
That's an excellent point. Excellent point.
Mark, I just want to make the point on that slide also that we're so used to the beat the market by 5% as better investing members, a lot of us, that we forget how aggressive that goal really is. And
Absolutely.
we forget to celebrate the fact that even beating the market by 1% or 1.5% or 2% makes a significant difference in the size of your nest egg if you have a long time horizon. So, I get two messages. Number one, keep trying to beat the market, but number two, don't become morose, don't become upset when you only beat it by 1%. You're still doing better than an awful lot of the investing public, and you're adding significant amounts of money to your nest egg.
Absolutely. One of Tom O'Hara's favorite things to talk about, by the way.
That's a good point. So there's two important differences in the thrift savings plan from an IRA or a 401k I wanted to point out. The first one has to do with beneficiaries. Many people name their spouse as the beneficiary of their IRA accounts or TSP accounts, and as you know, for an IRA, the surviving spouse can roll the deceased spouse IRA into a spousal IRA, and then can name beneficiaries to pass that on to the next generation or whoever the beneficiaries are, and then they get to receive that money as an inherited Roth. A little quirk in the TSP, though, if a spouse becomes what they call a direct beneficiary, in other words, the TSP member dies and the spouse is named as the beneficiary, it's a special category, and they call them a beneficiary participant. And what that means is that the surviving spouse who now just inherited the TSP account has two options. They can continue as a TSP account holder, or they can move that money over into their IRA. And in the case of a spouse, you have that special rule about spousal IRAs. If you keep the money in the TSP account as the surviving spouse, the disadvantage is that when they the surviving spouse names a beneficiary, the entire distribution to that successor beneficiary is taxable. So there's no stretch out, there's no inherited Roth. So the solution to that is, if you're in that situation, is probably to move out of TSP. The surviving spouse should probably move out of the TSP and roll it into a spousal IRA, and then retain all the flexibility that comes with that. That's not something that's very obvious, but it's a pretty significant difference, for a traditional family where you're thinking of the spouse and then the children, or some other family.
I think it's very important, because you could really get blindsided.
Big tax bill. Yeah, big tax bill if you have to pay it all immediately.
If either one of you two guys want to give me $1 million, I'll figure out how to pay the taxes on it. But still.
One other significant fee, just go by, I didn't put on the slide, but I just kind of smiled because I mentioned it to my wife. Spouses of TSP account holders have to sign off on distributions and loans. It's by law. Okay. So, and it's a good thing. It was intended to protect the spousal interest. I did have the question, though. I said, okay, well, what happens if the spouse doesn't agree? And I went back through the regulations, and all I can say is it gets complicated. If the husband and wife can't come to an accommodation on that, then there's certain provisions if they've been living apart for 3 years, or there's a court order. But it gets a little complicated. So that's just a small point. Oddly enough, a TSP account holder, though, can take the spouse off the beneficiary line and doesn't require the spouse's signature. So there's not a lot of consistency on the rules, but that one is in there.
That's flexibility for sure.
Yeah. And then this is the last one. I just mentioned very, very briefly, the TSP, you can take all or part of your TSP account and buy an annuity. They publish the annuity interest rate, so you can get a rough idea of what the annuity will pay. It comes with all the benefits and disadvantages of an annuity. The critical point here is, though, once you do this, it's irrevocable. There's no going back. So you need to be really careful. The government doesn't subsidize the annuity. The TSP has a commercial provider that that underwrites the annuities. And I have not researched. I can't tell you if it's I can't compare it to commercial availabilities. I've never studied annuities, but it's just another option. That's the point. And they're very flexible. They have single joint. They have some with inflation, and they have so they do offer a lot of good options if an annuity meets your needs. And you don't have to use your entire account for it. You can just designate part of your account if you feel an annuity meets your needs. Okay, Mark, I think
Very
that's all I
cool.
wanted to cover.
Well, thank you, Ty. This has been outstanding. And on behalf of our audience, I just want to express our appreciation. Please, if you have any follow-up questions, you can send it to any of the 3 email addresses on the screen, and we'll compare notes or do whatever it takes to find an answer for you. So thanks again, Ty.
You're welcome. Glad I could do it.
All right, so we're closing down the program. Just a reminder, we do have some fairly interesting stuff coming up. We're going to be taking a look at Meb Faber's analysis of dividends and perspective, and then, of course, our annual trek to hunt down some red rabbits. No animals are harmed in the making of the presentation. And then again, we do archive all of these sessions, whether they're roundtables or bull sessions or special educational sessions, on the YouTube page under Manifest Investing. And I put this here just to make the point that it was 9 years ago, almost 10 years ago, that we did the precursor to this program. So you can actually go back and look at that if you want. Got to drill down. And there's our slide for the day, our image for the day. Pretty sure that's the Mississippi River. Is that correct, Ty?
Yes, sir. It was the end of they call it RAGBRAI, the Iowa Register's Great Annual Bike Ride Across Iowa. That year it was 484 miles. So the tradition is to dip your tires in at the beginning and the end of the ride across Iowa.
Wow.
And that's the Mississippi River there. Yeah.
How many days is that?
7. They do it over 7 days, so it's not too bad. It's like a moving block party. They have 15 to 20,000 riders. They basically close the roads off where the riders are because there's so many of them, and it's a lot of fun. But
That's pretty cool.
It's hot. It's hot in Iowa in the summer, though, I got to say.
Ken, I think Ken, you may want to do that. I think I'll set it up.
Yeah, sure. Okay. That's for me.
Looks like good fun. Maybe if I got to drive a golf cart or something alongside, I don't know. All right, we'll just close with our comment that we believe that you can make successful investing unimaginably imaginable. And again, small differences can be huge differences once you get them in context. That is a permanent link to the sessions. You can sign up for any of our Tuesday sessions for the entire fourth quarter of 2023 using that link if you choose to do so. And Ken, do we have anything else in the hopper?
No, we've kept up with the questions and the concerns real well, and want to personally thank Ty for the work he did on this. This was a very interesting presentation, and I'm sure our audience will have some feedback for us.
All right. Well, everybody get out there, find those really great best small companies that we can't miss with, and send them to us. And we'll thank you in advance. Take care, everybody.
Good afternoon, folks.
Good afternoon, Mark. Ken, take care.